Welcome to the University of Scotland-Whitewater. In the culmination of Doctor of Business Administration comes the dissertation. Assan Jallow has been working diligently on this for over a year, and it basically is about Basel III, which is banking regulations on capital requirements and asset risk, and banks and Africa. Assan is actually with a bank. He's a professional in the banking industry, so this strikes very closely to home. And I welcome him. Please come up. Thank you. And we will ask you challenging questions.
Thank you so much. Thank you. Yeah, good afternoon, Professor Kasian, Professor Pavin, and Professor Michael Winden. So first of all, I want to send some acknowledgement because I want to thank God for giving me the opportunity, despite all making me to weather the storm and also survive the scars and reach this level of academic excellence in the journey of education and learning with thankfulness and gratitude. Secondly, it is challenging to articulate profound gratitude to my dissertation committee, as words alone are not enough to express my feelings of excitement for their dedicated support and guidance, as my heart melts with the warmth of grace and goosebumps of an energized, positive mentality, driven through the lens of through the laws of attraction, generated through spirits of hope, belief, faith, focus, dedication, and patient-first mentality. Special thanks to my dissertation chair, Professor Dr. Russell D. Kasian, as Helen Keller says, alone we can do little, together we can do better, and so much. Your advice, knowledgeable guidance, constructive feedback, and countless hours reviewing my work culminating in the final execution of this manuscript have helped me immensely, improving my thinking and making me appreciative of a critical perspective in my endeavor. To my dissertation committee, Dr. Matu Winden and Dr. Pavin Pavatwa, your expert ideas, suggestions, recommendations, and advice have fostered my intellectual growth, and the timely feedback has significantly improved the quality of this dissertation. I also appreciate the time and effort you both have dedicated to my committee, as all of you have contributed to something that positively enhanced my learning. To Dr. Pravin, thanking you is never enough, as you have multifaceted role has been particularly extraordinary, and only serving as an essential pillar behind the success story of the UW DBA program, but also as a visionary leader who prioritized students' welfare and needs, and inspiring me to pursue excellence at every stage of this work. You have always gone above and beyond in meeting and exceeding my expectations. I'm particularly grateful and appreciative of all you have done for me throughout this program. As Cicero states, gratitude is not only the greatest of virtues, but the parent of all, of others. Thank you once again for constantly checking in me and being a Northern Star with an unmatched positive mindset throughout the journey. Thank you. I'm also indebted to the faculty and teaching staff of UW-Whitewater, under whose hands I have passed through. So much have been learned, and so much have been impacted in my life, which I'm going to use as essential tools that will help me to harness my knowledge capital in the world of work. Thank you so much to everyone. And to my DBA cohort colleagues for DBA 7 and DBA 8 colleagues, I also appreciate working with you for all the past 4 years, brainstorming and debating on critical issues in and outside the classroom, particularly in the teaching practice seminars and projects, has played an important role in enhancing my thinking and gaining deeper knowledge regarding research design, data analysis, lecture, hypothesis development. The words of encouragement that we exchanged during this journey have been incredibly helpful, and I want to express my appreciation for the friendship and working relationship that have been established so far. I would also like to acknowledge my company, Catalan Biologists, for the support and funding provided to me. Your belief in employee dedication and education and personal development made it possible for me to accomplish this task. I would also like to thank all those colleagues who have contributed one way or the other, have encouraged me and assisted me in my studies. Your support have helped me a lot, especially in times when it is most difficult. And I'm also glad and grateful that your collaboration and collegiality have made balancing work full-time and study feasible and enjoyable. Thank you all. Special thanks also to my former employee in the Gambia Revenue Authority, where I have worked for 15 years prior to relocating to the United States in 2016. I appreciate all their efforts. They have been constantly checking on me day in and day out. I also appreciate my ex-wife, Erica M. Bailey, for her exceptional patience, collaborative support, and understanding in co-parenting our children, Catalan and Assis, which has been remarkable throughout the journey. As Nelson Mandela once said, it always seems impossible until it is done. I've extended my appreciation to my family and friends for their support during this period. In this regard, I would like to extend my sincere gratitude to my late parents who have nurtured my passion for learning as well as taught me the virtue of hard work. The confidence that they have put in me and the sacrifices that have been made has made it possible for me to stand today tall and be appreciative of everything that have been done to me. To my phenomenal wife, Senabu Cham, who is in Gambia, and my beloved 2 children, Suleiman and Aliu, it is impossible for me to find words to express my appreciation for your support. You know that my patience has paid off, and the love that you have displayed has been invaluable throughout the journey. Thank you all for believing in me and working with me. Thank you so much. So today I'm going to make a presentation on my dissertation, and the topic of the research study is on Basel III in Africa, implementation and performance effects. So the agenda of the program will go as follows. First, I will definitely share some context with regards to the background that has to do with the motivation, objectives, and research questions. And then I will talk a little bit about the methodology that has to do with the sample design, data collection methods, analysis, variable measurements, model specification and estimation techniques. Then I will also dilate much more on the data analysis and the results with regards to the findings and the discussions of the study. And then we'll wrap it up with summary conclusions and recommendations and Q&A. Thank you. So for the dissertation defense, I have 3 committee members. The committee chair is Dr. Russell D. Kessian, who is a professor of economics. Dr. Matu W. Winden is the Associate Dean of Graduate Programs at the University of Whitewater. He's the second chair. And then my reader is Dr. Praveen. The motivation one is professional and personal. I have a profound research and career interest in banking and finance, and especially also I want to branch off into teaching and consulting as I head out today. So that is one of the basic motivation behind this study. And the second one is to extend findings of prior studies. Extensively, people have studied Basel III regulations in banks, and for that being the case, especially in Africa, which is understudied, is so scarce with the literature. And then the reason why I want to do is to identify and address the significant gaps in those studies and literature in order to provide, a better understanding of the nuances and complexities behind Basel III and the impact it has on African banks' profitability, financial stability, and soundness. The third one, I want to contribute to the literature, which also tied to the second one. So why I want to contribute to the literature is to provide helpful policy guidance and insights and recommendations that have policy implications and for practice and theory in the field. Primarily, this is the very reason why I opted to examine the predictive relationship and the performance effects of Basel III regulation on African banks' profitability. Background to the study. So if you look at Basel III, development has been made, and Basel III introduced higher capital adequacy and stricter risk controls. So this definitely enables African banks to weather economic shocks, and then this increased trust in their stability and make them more resilient. So that's why the Basel III has improved the bank's capitalization and risk management practices. And also with regards to that, if you look at the profitability challenges in key African banks, despite these reforms, challenges like limited product sophistication and costly operation hinders bank performance in African contexts. And then for that being the case, it makes them to be very difficult to be able to handle or have the ability to maintain robust profit margins compared to developed economies like the United States, Europe, and Asia. And then these ratios also ensure banks can withstand liquidity stress and maintain funding stability, contributing to overall financial soundness despite their initial operational adjustments. Implementation when it comes to Basel III adoption, evolutions, development in Africa. The African banking sector has undergone structural, institutional, regulatory, and financial reforms. And some of these, the reason why the Basel Committee on Banking Supervision has developed global regulatory framework. The rationale is to strengthen banks so that they can enhance financial stability and soundness. So to provide a historical context, the development and evolution of Basel III regulatory agenda started in 1988. And then it was called Basel I, which focused on point-in-time regulatory compliance, and then for larger international active banks that were based on the application of principle-based simple asset risks and weights and internal models for market risks. And then Basel II was also, the scope was expanded to Basel II, which came into 2010, and the rationale behind that was to include smaller banks. Because earlier on, it was on larger banks, but they also wanted to incorporate and include smaller banks. And the rationale behind it was to focus specifically on internal model approaches for credit and operational risks for these banks. And then Basel III was introduced in 2013. Basically and primarily, it was aimed at strengthening the financial system, that is safeguarding the financial stability and soundness of banks, and then while ensuring future sustainability and market systematic risks based on banks' receivable risks, leading to enhanced liquidity standards and non-risk-based capital. And this was basically for leverage and standardized approaches for these banks. So the financial sector of an economy plays a very critical role, as you can see. And for that being the case, Basel III coming into play also has to tie in trying to make sure that it enhances the financial sector, not only per se for profitability, financial profitability, but also for bank stability and also for bank soundness within the African context. Impact on lending and economic growth. So if you look at the impact, the increase in capital requirements under Basel III led to reduced activities, lending activities. So while banks also adapted to the new regulations, the restricted ability that has also led to initial slowed down economic activities, illustrating a trade-off between stability and growth. So for global and regional adoption variances, the varied adoptions that was also adopted or introduced or implemented across the regions highlights the differences in banking, maturity, and also regulatory environment, with African banks often outperform minimum standards that were established, and that has to do with the capital adequacy ratio. So, and the other one was also basically increased transparency and stakeholder confidence. By mandating improved reporting and risk management practices, Basel III has bolstered confidence among stakeholders essential for long-term sectoral stability and growth. Research problem. The research on Basel III has produced mixed results. And then it also has revealed some gaps in our understanding of its impact. While some studies suggest positive relationship between regulatory components of minimum capital requirement and profitability, others also have presented conflicting outcomes. And then some of these outcomes are focused on limited variables, small sample size, from single countries with also limit the generalizability of those studies. And this underscores the need for broader research that examines the interplay between regulatory frameworks when it comes to African macroeconomic and bank-specific factors, particularly in African contexts where such studies are scarce, they are limited. So the challenges also has to do with African banks also struggle with limited financial system, weak regulatory framework, and poor sectoral diversification because of product sophistication and stuff like that. Unclear impact of Basel III implementation in Africa. The African banking sector has also faced unique hurdles, including small financial systems. One of which was that with limited access and poor sectoral diversification. These challenges are compounded by weak regulatory framework. And some of these compounded weak regulatory framework has also led to the limited number of high-quality borrowers from the African context so that they can have access to funds and some of these things. Because if you're able to draw some loans from the banks, it also enhances the banks to move and be moving capital from one level to another. So that was one of the basic rationale behind it. Addressing these structural challenges is essential for long-term stability and resilience of the banking industry in Africa. However, the effects of Basel III in Africa remain uncertain due to underdeveloped infrastructure and inconsistent application across the countries. Some studies suggest that the higher capital and liquidity requirements of Basel III may increase borrowing costs, potentially slowing down economic growth. However, there is limited research on how African banks adapt these regulations to their operational realities. This gap calls for detailed studies to assess how Basel III regulations affects banks' profitability, financial stability, and credit access for individuals and businesses in the region. Research objectives. The purpose of this study is to examine the implementation and performance effects of Basel III regulations on African context or African banks' financial performance. To achieve these objectives, the study aims to develop a better understanding of the evolution of Basel III implementation in the African banking sector, centering on the degree to which the framework has been received, adopted, and integrated into the African banking regulatory and operational framework by examining its effects on bank soundness and stability. Research questions. We formulated the following research questions to determine the predictive relationship between the explanatory, moderating, and the dependent variables of the study through the lens of Basel III regulation using the pecking order and the stewardship theories. So the first research question is to what extent did implementing Basel III regulations influence banks' performance? We want to know the impact it has. What was the relationship that Basel III, and when we talk about Basel III, we are talking about time point. And if you look at the time point, it was based on, the data was driven out of a decade data that was received from Wharton Data Research Center that was for a 10-year period, 2013 to 2023. So we wanted to determine those time points every year, what impact it has for the implementation of Basel III on African banks' profitability. The second research question is, what is the relationship between capital and banks' performance? We want to know what is the relationship. When it talks to capital, we want to know what is tier 1 and tier 2. What are the relationships that they have when it comes to banks' performance? And the third question also, we want to see how does non-performing asset moderates the relationship between the independent variables that has to do with debt, non-performing loans, provision for loan losses, capital tier 1, tier 2, etc. Conceptual framework. The conceptual framework, we use the 4 Basel components that has to do with minimum capital requirement earlier on with the literature, capital adequacy, capital budget premium, and liquidity coverage ratio. And then we use management quality to see how management quality moderates the relationship between these 4 Basel IV components when it comes to return on assets and also on return on equity. So ROE and ROE are the dependent variables. And then the 4 independent Basel IV components are the independent variables. And then minimum capital requirements and risk-weighted are all based, which includes MCR, which includes the minimum capital ratio, and CAR should negatively influence the dependent variable. And then the other one, while CBP, which is the capital budget premium, would positively influence banks' performance. However, the LCR, which is the liquidity coverage ratio, should negatively impact the dependent variable. And MQ, the management quality, moderates the relationship among these variables. Sample and procedure. The first point, the study analyzed data from 609 banks across 46 countries from 2013 to 2023, focusing on the relationship between Basel III implementation and key financial. And based on that, we divided the data into two. That is on 2013 to 2017, and then from 2018 to 2023, so that we can say pre-implementation and then post-implementation. So the data were categorized into pre-implementation, as I said earlier, and then banks were also sampled based on their compliance with Basel III regulations and represent larger commercial banks in Africa. If you look at the second point, that the data was divided into two distinct periods. But also the third point explains the reason why the sample banks were deliberately chosen to represent large commercial banks in Africa that comply with Basel III. Research design. For the first point, the study used a quantitative correlational design, which is appropriate for investigating relationship between variables without the need for experimental manipulation. So the panel data approach helps control for unobserved variables that could potentially affect the results, ensuring greater reliability in the results. The second point, if you look, we use stratified random sampling technique was applied to ensure sample banks were representative. So the reason why we did that was to ensure that the sample population reflects the diversity of the banks, which is very critical. And then why we did that was this approach helps to mitigate potential bias that can be generated and also to provide a representative sample, which is crucial when analyzing the relationship between Basel III and the independent variables across also with the moderating variable. The third point was that we used multiple regression analysis, and then the multiple regression analysis explains the regression test of how we are able to test the relationship between the independent variables like Basel III implementation, capital tier 1, tier 2, net performing assets and stuff like that. So the variables are here. We have two dependent variables. One has to do with the return on average assets, and the other one has to do with returns on average equity. So the first measures the profitability by evaluating the stability of banks, how banks generate income from their assets. And for the return on average equity, basically assesses the profitability by determining returns on shareholder equity. So these are the two dependent variables. And then the independent variables were also based, these are the regulatory metrics that has to do with Basel III, that has to do with the time point, and this was based on a dummy variable, trying to distinguish pre and post implementation of Basel III. And then the minimum capital requirements ensures banks hold sufficient capital to protect depositors and maintain stability. And then capital adequacy evaluates the bank's stability and ability to absorb financial shocks using a capital to risk ratio, asset ratio. And liquidity coverage ratio measures a bank's ability to meet short-term obligations with high-quality liquid assets. Moderating variable. The moderating variable was management quality, assesses the operational efficiency, focusing on leadership ability to maximize resources and minimize costs. And the control variable was that we use country. The reason why we use country was that because of a country dynamics, because we were using almost about examining 46 African countries. So we use the country to control, and then so that we can look at the impact it has on financial performance and regulatory implementation. On the sample. On the sample, the data set captures an extensive period allowing for a detailed comparison. And the reason why we did this was that between pre and post implementation, that's why we said the data span from 2013 to 2017, that was the pre, and then 2017 to 2020, 2018 to 2023, that was for the post. So by splitting the observations into pre-implementation of 3,045 cases, and for the pre, and then for the post was 3,654 cases. the data set provides a strong foundation for longitudinal analysis. So the reason why we did that also, we used data cleaning process. We used the SPSS listwise. So the reason why we did that was we used to remove cases that were zero from the data. And then why we did that was that this step helps to maintain the reliability of the results. So that was the reason why we used the listwise for SPSS, so that we can remove potential biases introduced by incomplete records. And then the variable inclusion, the inclusion of Basel III matrix, example like capital tier 1 and then capital tier 2 alongside profitability metrics like return on average assets and return on average equity, enables a multifaceted exploration of financial performance by incorporating these diverse indicators such as loans, securities, and non-performing assets. The data set facilitates a holistic view. The reason why it provides a holistic view, it gives a holistic picture of banks' operations and their responses to regulatory changes. That was for the sample. Model specification and estimation techniques. The model specification and estimation techniques on model 1 is return on average assets, and then on model 2 is return on average equity. So it provides a kind of a structured framework that guides the investigation of the relationship among the variables, and then hence enhancing the validity and the reliability of the findings while ensuring the results are robust and interpretable. This is the reason why we have two models to test the data. And variables measurement, we have a list. So all of them, and some of these sources were also sourced from S&P Global, from the Wharton Data Research Center. So we have a list of variable measurement that has to do with capital, whether it's going to be like tier 1 capital, whether or tier 2 capital, whether it's going to be negative or positive. So these are the measurable variables that we intend to look at, and this will definitely help and guide the study, so that at least it can provide, like, the reason why we have this, it helps to define how each and every variable is being measured and examined across the data that we have. So now we come to the results, the study. Descriptive statistics. If you look at the time point, and then we have the minimum, maximum, mean, and the standard deviation. So if you look at the color-coded figures here, the reason why I'm trying to put this thing into color-coded is to give an explanation of what actually happened. And because I'm distinguishing the data between pre and post implementation of Basel III. So if you look at them, it simply means everything was significant at post implementation of Basel III than pre implementation. So for research.
So I do have, can I ask a question? Yeah. So I'm not sure, sometimes I'll ask a question, and I don't know is always a fair answer. Okay. So how is it that in period 2, that the return on average assets and the return on average equity, that the minimum are exactly the same? I want you to double check that number there. Okay.
They're not.
No, it is a negative 26.08.
Yeah, that's ROA. That's the minimum.
That's the minimum.
That's what you from ROA or for. Oh, I see. In the spirit, you are the same between the two of them.
These are two different variables. Return on average assets is different than return on average equity.
Mm-hmm.
And you see a difference on the top in epoch number 1.
Maybe just check the typing.
I want you to make sure it's typed right.
Okay.
Because I'm sure it's a typo.
Okay, thank you. I'll check that. Thank you so much for spotting that on intended oversight. Thank you. And then we'll go to the results number 1. So if you look at results number 1, overall, Basel impact had no statistical significance, or either on a direct effect or indirect effect on ROE. So the reason is that because of the p-value was at 0.855, and then for return on average assets, and then for return on average equity was on 0.493, indicating its limited influence on bank performance. That was on the Basel implementation. That was on the time point from 2013 to 2023. And then if you look at the financial health metrics stood out as major here, it stood out as major impact. The reason why it stood as a major predictor of bank performance. If you look at net income, it positively impacted ROA and then an ROE, while non-performing assets and provision proposed for loan losses negatively affected both metrics. Why they negatively affected on both metrics was based on the unstandardized deviation. When I tested it and I saw it, it was so negative on that. But on the other side, on the p-value, it was on certain things. So that was the reason behind it. And then on country-specific variation, performance outcomes varied significantly across countries. For example, countries like South Africa and then Sudan, because for that being the case, showing strong positive effects, while others exhibited no significant or negative effect. Am I going too fast?
No, that's good. That's perfect.
Oh, thank you. So this is still on continuing on results 1, that is the univariate analysis. So for table 1, point-Basel correlation between time period, return on asset and ROA, if you look at the point-Basel, it was significant at 0.005 and 0.11. But however, the p-values were not significant. Because the point-Basel, if you look at statistically, the point-Basel correlation is a statistical method that measures the strength of the relationship between the variables, of the continuous and the dichotomous variable. However, if you look at it and then, however, the correlation were not significant. That was for the p-value. And then we move to result 2. Capital structure plays a critical role in determining financial health and efficiency of banks. So if you look at Tier 1 and Tier 2 capital, they represent core and supplementary sources of funding or income, as we can say, respectively. However, a statistically significant positive relationship exists between Tier 1 capital and ROA, return on average assets, as Tier 1 capital enhances profitability by showing or by reducing risks. However, the focus on Tier 1 capital can dilute return on assets on average equity due to the retained earnings accumulation in banks. Conversely, Tier 2 capital tends to have a negative impact on both ROA and ROE. The reliance on supplementary capital, such as subordinated debt, often signals an increased risk and inefficiency, reducing returns and suggesting a less sustainable funding approach. So that's basically the negative impact of Tier 2 capital.
I would also argue that because allowance for loan loss is included in your Tier 2 capital, that would decrease your profitability because you're pushing it there. And it basically affects the numerator of the equation.
Okay, thank you. I think, did I? Continuation on results 2. So here, we also have to look at the geographical variability impact it has. Because the reason why we are trying to do that is to examine the effects of capital on performance, which can also vary significantly across countries, because countries are not at par at the same time, because economics are different. And for that being the case, with some nations showing positive impact while others are neutral or negative. And then the other thing was that the statistical findings revealed that Tier 1 capital is a strong positive predictor of ROA, reinforcing the notion that core capital contributes to operational efficiency and profitability. However, we can also conclude on the implication for capital strategy. Banks should adjust their capital strategies based on regional insights, because also within the African countries, they also have regions. They have 4 regions that are out there. And for that being the case, achieving an optimal balance between Tier 1 and Tier 2 capital is crucial for maximizing profitability while minimizing associated risks. Banks must also consider regional variations and regulatory constraints to tailor their capital requirement management and practices effectively, which will also help enhance the sustainability and financial health growth of their various economies. We go on to recite number 3, which is the moderating and moderation analysis. The moderating analysis has to do with the non-performing assets. Initially, it was on management quality. Based on the data, a lot of things changes along the way. So for that being the case, we put NPA to represent the management quality variable. So for the moderation, we look at it has an impact, significantly moderates the relationship between the independent variable that has to do with relationship between independent variables, that is Tier 1 capital, loans, and net income. What we did on the interaction was that we times it by 2. And then these were the 3 variables that has significant impact. It was almost 14 variables, though all the remaining ones didn't have any significant impact on both for return on assets and also on return on equity. So if you look at here, debt, non-performing loans, they were not significant. However, capital Tier 1 was significant, and then loans were also significant, and also net income were also significant. These were the significant values. The remaining variables, they were not significant when we tested it. So we still continue on. Based on the moderating effect, we divided it into 2. One was how we checked the interaction effects was on the return on asset, on average asset 1, and then the second one was on return on average equity. So that's why we're able to draw on those things to see it impacts it has, because these are 2 dependent variables. So the same thing applies. For both ROA and ROE, only 3 variables has a significant impact on the relationship. So summary of the results. The time point 1 was not statistically significant, and then because the hypothesis A, implementing Basel III correlates with bank performance, was rejected, as the result indicates that hypothesis 1, the null hypothesis, Basel III does not significantly correlate with bank's performance, was not supported. So the other one has to do with H2 capital requirement, that is the RQ2 question. Tier 1 and Tier 2 statistically and significantly influence bank's performance. It was supported. But for the third hypothesis, that has to do when we tested the interactional effects of NPA alongside the 14 variables of the study. 3 of the variables were significant. For that being the case, I determined based on logic that they were partially supported because of the 3 variables, they were having significant interaction effects. Discussions of the results. The discussion of the results first, Basel III regulations do not significantly predict the profitability of African banks. The study found no statistically significant relationship between Basel III and implementation and bank profitability. This highlights that the framework alone may not be the key driver of profitability in African banks. So the time point influenced bank performance more than Basel III implementations. The data revealed that performance changes over time because of the decade-long data that was obtained from RRDS. So between the pre and the post implementation, suggesting that external factors or temporal influences may affect profitability more than the regulatory requirement. And the third one has to do with the Tier 1 capital is a critical factor in improving ROA. However, banks with tier 1 capital reserve demonstrated stronger ROA, underlining the importance of sustaining robust primary capital to enhance financial stability and absorb potential losses within the banking context in Africa. Discussions of results. Increase in loans and net income contributes to higher ROA and ROE. The study emphasizes that profitability improves when banks boost their non-performing loans. When they boost their non-performing loans and net income, suggesting these are effective levers for enhancing financial performance. The other one has to do with the study findings. It also diverged from a prior research linking Basel III to increase profitability. Unlike earlier studies that link Basel III profitability gains via operational efficiency, what actually happened was that this research suggests varied outcomes due to contextual factors like methodology and regard to differences. Capital structure remains pivotal, important for profitability regardless of Basel III rules. Aligning with prior research confirmed that capital structure enhancement, including adhering to Basel III capital requirements, are essential for sustaining profitability amidst diverse economic challenges across the African continent. Discussions of results with regards to literature. The study found no evidence linking Basel III implementation to increase profitability in African banks. This suggests that while Basel III may enhance regulatory compliance, its direct financial benefits in this context are minimal, possibly due to unique regional economic conditions. The other thing is that the regulation helps manage financial risks and stabilize liquidity during crisis, but their influence on profitability remain unclear. For that being the case, the African banks might need additional strategies beyond Basel III to drive growth and efficiency in their operations. Discussions of results on literature still. Banks with increased tier 1 capital reserves show stronger ROA, reflecting enhanced financial strength and stability. As such, this finding highlights the critical role of robust capital structures in enabling banks to absorb losses and sustain operations during crisis. The study also confirmed that profitability improves when banks grow their non-performing assets and net income. What this evidence suggests is that it aligns with evidence that these factors enhance banks' ability to leverage opportunities for financial growth and stability. Limitations. In any study that we undertake, there might be some limitations. And limitations are key components that also drive and helps the study so that we'll be able to see some nuances and complexities that are associated with the study. One was that the use of secondary data may have limited the study's validity due to outdated, incomplete, or unverified information. Because that's a challenge, because it challenges the accuracy and also a relevance and potential bias that can be driven out of it. And for that being the case, this limitation underscores the need for further studies to consider primary data collection for enhanced reliability. The second limitation was correlational design revealed relationships but could not establish causation. So the reason why this is important is that future studies could also employ experimental or longitudinal studies or designs to address this limitation. The third limitation was omitted variable bias, limited the control of compounding factors. Unaccounted variables may also have influenced the results, challenging the robustness of the findings. Incorporating a broader range of variables or alternative methodologies could also strengthen future analysis. Still on limitations. Completeness and generalizability issues constrain the broader applications on finding. Limited controls over the data collections, process, and context-specific data sets reduce the applicability of results. Expanding data, sources, and context should also enhance generalizability in future research. The other one limitation was the ordinary least square. Multiple regressions face challenges with outliers, collinearity, and model fit. So what actually happened is that statistical issues such as outliers and collinearity may have influenced the outcomes, while the lack of a clear goodness of fit measure further complicated the analysis. Therefore, exploring alternatives statistical techniques could address these challenges. There is also restricted time period, limited data comparability across different time frames. The narrow temporal source or narrow temporal scope of the study affected the ability to analyze trends over time. So therefore, incorporating longer time frame or time series methodology could provide deeper insights into the temporal effects of such study. Methodological implications. Appropriate measures are crucial for addressing or assessing predictive relationship between variables. However, the study highlights the need for precise and relevant metrics to evaluate the connections between Basel III components and profitability measures like ROA and ROE. Accurate measurements are key fundamentals as they enhances the reliability and conclusions and guides informed decision making in banking research. Future research based on the methodological implications could benefit from diverse sampling methods and design. While this study used stratified random sampling, alternative techniques like simple random or cluster sampling, Bayesian importance sampling, multi-state and systematic and optimal allocation sampling could also provide more comprehensive insights. Such methods might better capture variations in data and then offering a further understanding of the relationship between the variables that are under investigation. The other one has to do with the tailored methodological are essential for advancing Basel Accords research. The findings also emphasize the importance of developing customized research design to address the specific objectives in studying Basel regulations. Innovative approaches can lead to deeper insights and more practical applications in the banking industry. Theoretical implications. The study integrates two theories that has to do with the pecking order and the stewardship theory in trying to predict and explain the relationship it has with banking performance. By drawing on the pecking order and the stewardship theory, the study provides a nuanced framework in understanding how these theories interact with Basel III variables and profitability measures. This integration enriches the theoretical insights into banking regulations and financial performance. The finding also emphasizes the need for further exploration of capital structure theories is necessary to grasp their complexities. Even though the finding emphasizes the importance of delving deeper into capital structures, what actually happened is, if you also want to uncover their contextual and empirical influences, such exploration will help clarify the intricate mechanisms by which these theories affect banking performance. However, expanding the theoretical framework to include approaches like Modigliani and Miller, net income and net operating income theories can offer new perspectives on implications of Basel III. These frameworks may reveal novel applications and adaptation of banking practices in diverse financial contexts. Practical implications. Policy makers such as central banks should prioritize implementing Basel III regulations to enhance the profitability and stability of African banks. This focus on the banking sector fills a critical gap in research that predominantly centers on other global regions. So bank managers can also strengthen financial resilience by maintaining required Capital I reserves. By adhering to Basel III standards, bank leaders can actually bolster their institution's financial strength and this can also help and crisis management capabilities. Adequate Tier 1 capital reserves help banks absorb losses and maintain operational stability during economic downturns. Adapting to Basel III, the study also underscored the need for African banks to align with international capital regulations for long-term stability. Adopting Basel III standards and equip African banks with a framework to navigate future financial crises effectively. This alignment is very key. It also helps not only improving the financial strength and also not only improving the financial strength, but also fosters the global confidence in the stability of the African banking industry. Future research recommendations. Future research should prioritize primary data collections to address limitations of secondary data. To translate the findings of this study into actionable insights that can drive positive change and inform practice and theory, the following recommendations have been suggested. One, we have to keep on using primary data, such as interviews, which can provide more accurate, relevant, and verified information on Basel III implementation. This approach not only does it reduces issues like bias and outdated information, but also it can lead to more reliable findings. The second one has to do with adopting mixed methods. Research designs can enhance validity and generalizability. There is the need for triangulations, which is very key when you're conducting studies like this, so that at least you'll be able to dive into mixed method instead of only focusing on quantitative research and based on secondary data, which is also very good. So combining quantitative and qualitative data enhances and allows us to have a deeper understanding of the study or an investigation that we want to pursue. So the other thing also has to do with future studies should also prioritize primary data to address limitations. Recommendations. Investigating region-specific challenges in Basel III implementation can provide nuanced insight, which is very good. So we have to look at we have to further investigate and see what actually happened into different regions. Looking at the African context, that is based on 4 regions. So we need to look at what actually is happening on the south side, what is happening on the east side, west and north. So it also will give us a better picture, a holistic picture. So there is the need to examine the long-term effects of Basel III implementations, uncover trends and impact over time. Future studies could also investigate other factors such as technological advancement, which is also very key, and market conditions and management practices that interact with Basel III implementation. This holistic approach enhances the predictive power of research model. Recommendations for future practice. One, central banks in Africa should enforce Basel III regulations as mandatory practices. Enforcing Basel III as regulatory practices or Basel III regulatory standards enhances or ensures that banks adhere to the framework. And then enhancing financial stability, strict compliance with the Tier 1 capital requirement provides a robust buffer against future financial crises as highlighted in the study findings. There is the need for mandatory adherence to Tier 1 capital requirement, which can also improve financial resilience. African banks often face liquidity challenges. Maintaining required Tier 1 capital levels strengthen their ability to absorb financial shocks. This approach not only promotes long-term stability, but also builds confidence in the banking industry. So there is also the need to also address the liquidity concern through regulatory adherence, which also minimizes vulnerability. Strengthen liquidity positions ensure banks can operate effectively during periods of economic stress or uncertainty. Recommendations for future practice. Banks should adjust lending practices based on economic and financial conditions. The need for tailoring lending strategies to current market conditions limit overexposure to risky assets. This proactive approach is key because it safeguards profitability while also managing or maintaining adequate capital reserve. So the other recommendation is limiting capital length against risky assets helps maintain Tier 1 capital requirement. By controlling the amount of capital allocated to high-risk borrowers, banks can meet regulatory standards. This practice ensures financial stability and reduces the likelihood of significant losses or default that are generated through loans that are issued to borrowers. So there is also the need for also implementing these challenges to ensure that African banks are better equipped to handle economic challenges, improve practices. Summary. The study explored the impact of Basel III regulations on African banks' performance. This research fills a gap by analyzing the relationship between Basel III regulations and banks' performance in Africa, offering a regional perspective often overlooked in global studies. For that being the case, the findings provided insight into how these regulations influence financial outcomes in African banks. There is no significant correlation that was found between Basel III regulations and banks' performance. The results indicate a weak relationship between bank Basel III implementation and key profitability measures like ROA and ROE. This suggests that while Basel III is crucial for stability, it may not directly enhance profitability in the African context. So maintaining adequate capital income and loan level is vital for banks' profitability. Banks should prioritize achieving standard levels of net income, Tier 1 capital, and loans to enhance profitability. Such measures or practices may not only strengthen profitability, but they can also prepare banks to withstand future economic challenges effectively. Thank you so much. That's the end of the presentation.
All right. Excellent. Well, I'm going to ask you first. Well, one thing, let me be clear. You have to go back to the middle slide. You have you basically copied your non-performing assets in the middle. I have a question for you. Is this one? No, I think it's right before that. It's I can't see that part. You have to understand, you have under the non-performing assets have positive effect on ROAA, a return on assets. It's actually negative. It's in your paper. You have a typo up there. That's because obviously non-performing assets would cause you to lose money. And so that was just one observation I had that I wanted to unfix it. But that's not in the paper. That's on the slide. On the slide. The other thing is I wanted to be keep in mind that the Tier 1 capital is the result of Basel III. Is encouraging Tier 1 capital, which then leads to greater profitability because it leads to better liquidity management. And so when we say that Basel III has no effect on profitability, it's indirect. Is that, it's affecting Tier 1 capital. Tier 1 capital grows with profitability. So this leapfrogging between them.
Okay. Absolutely. Thank you.
Matt?
So I have a couple of questions, just kind of, these are mostly big picture, I think. So the study is limited to large African banks, is what you defined it as. Now, part of Basel II implementation was to expand to mid-size and smaller banks, right? So it's okay that you're limiting the scope to a certain subset of the banks, but then in terms of the outcomes, right? You're basically saying what you're finding is there's not a lot of impact on a Basel III in terms of performance for these large African banks. What do you think, just having read all of this on this literature, do you think that is because of the size of the bank? Maybe they're just, there's not as large effect of the framework, but if you were analyzing the mid-size and smaller banks, that you may actually find results then?
Absolutely. Yeah, basically, primarily, that's a very good question. And then that's a key component, even though if you look at the size of the bank, which also comes into play. And then if you also compare the African banks with the European and American banks, they are at different wavelength. Because also when it comes to the risk-weighted assets and stuff like that, African banks are not yet there. Because even though despite all the accords on the framework that have been established for them to adhere to, they don't even look at all of these frameworks. So they just look at something that is, applicable to them in that context, and that also impact. And that was the reason why they didn't look at smaller banks, because they might not be in that range to be able to implement certain things. Yes.
So I mean, I think that underscores that's a great kind of just analysis based on your feeling, even though you don't have the data, but also speaks to why the extensions of the model, extending it, this sort of analysis to those smaller banks is still important, because we don't know then essentially what the impact might be on these smaller banks, right? Smaller and mid-sized banks yet. So that's your next paper. So the second question that I would have is looking at the results for the countries. You highlighted that certain countries, it was pretty clear, certain countries had a positive impact, on bank profitability. This is outside, it's controlling for Basel III, but just in general, some countries had positive impacts on bank performance, while other ones had, it seemed like, no impact. I don't know if there was any that had a negative impact.
Negative impact, yes. Some of them, they have no or negative impact.
Okay, so some did have a negative impact. So do you find, just in your general understanding of the overall maybe stability, economic stability, political stability, that the countries with the greatest economic and political stability are the ones that would correlate to the countries that are having a positive impact on bank performance, and that countries with less stability are the ones that are having either no impact or a negative impact on bank performance?
Oh, thank you for that question. I think we can look at it from two different angles and two different approaches, because basically political stability has a huge role to play in an economic performance of a country. But also, if you also look at other countries, also they also have stable political instability like Sudan, but based on this study, they have a significant impact on those countries, positive impact on Sudan. But for countries like, we can look at countries like South Africa, Kenya, Botswana, Mauritius, all of those countries, they have a significant impact because they have a political stability. And then there's also economic growth because they're able to expand on their economy. And then they're able to introduce some of these rules and regulations that are applicable in other developed economies.
So even countries that were politically unstable in substance still actually
have some significant impact, yes.
That's very interesting.
Yeah, I think I'd have that in table 6, part of the dissertation, when I run some of these countries based on the data.
That's what I heard. Great analysis overall, very thorough.
I know, well, that's thinking it. Bring that slide down just a little bit. No, when you're looking, I'm looking at the prior. So now the descriptive statistics. Got to keep in mind, and I know you know this, but the reader is going to say, and I obviously can't see it from here, the minimum total assets at bank. What's that number? Okay, 1499 point.
In which year, Rich?
In Cree.
1499.71.
You have to indicate in the paper that's add 3 zeros. It's not a $1,400.
No, absolutely. Yeah, you're right. Absolutely. I'll put that into consideration. Thank you.
It's fine.
Okay.
But, I know that no one else in this room knows that. You think, boy, that's a tiny little cake. It's what Russ keeps in his pocket.
Yeah. So for me, just one clarification. How did you measure management quality? I didn't quite see it.
Management quality, if I could get back, this thing is not working.
From a manager professor.
Yeah, I should see it, exactly. Okay.
Economists are looking at the numbers.
You can just tell me, you don't have to. Yeah, so this doesn't divide it, but it doesn't really say what you used for it.
Yeah. So
let me just come back so that I can do. Yeah, management quality, if you look at.
Sorry. No. Yeah. While you're
Go slow. Can't keep up with your clicking. Yeah, there you go.
Management quality is here. Overheads over total assets.
Oh, I see. Overheads.
Overheads over total assets.
Okay, I trust that economists see that as an different quantity measure. So the other question I have is, if you didn't find anything, why are you supportive of Basel III? Because your recommendations is the banks should still do it, but then you didn't find support for the link between implementation and forced banks doing good.
That's a very good question. So the reason is that because I didn't find anything that was significant with implementation of Basel III. So that does not simply mean that it might not have a significant results, because if we look at the time point, because of regional variability, and then at that given time, because of the pre and the post, so we still, there is a need for me to go back and look at the data itself so that I can see what actually triggered those pre and post implementation of Basel III.
Okay, so you're saying that maybe you didn't assess everything you needed to find something.
Yeah, at that given time, because based on the data that I have, so this is deriving from the data. So I just need to look at what actually triggered that time period, because the post implementation at that given time, maybe at that time, to me, what I'm seeing is that at that post implementation, some of these components that are on Basel III, on Basel Accords, were not there before. So that also impact the performance or profitability of these banks.
Okay, please. One last question. What are you going to do with all of this now? Are you going back to your company or publishing it? Well, what's up?
Yeah, thank you. That's a very good question. I'm going to publish, I'm going to keep writing, and then I'll work with the same committee that I work with. And then because you guys have more expert ideas into seeing these things, to publish it into a high impact journal. And then also, I'm also trying to look at transitioning into teaching at the time, or anything that I just continue with my company, but I'm just looking at opportunities. I'm open up to everything, because I want to see whereby I can get my hands dirty and then keep writing, because I also want to enhance my research skills, which I have developed some certain things, components with it, and I want to keep doing it, because it has opened up a lot of opportunities for me.
All right, I'm good. I would encourage underneath four-page dissertations are best served by 22-page papers. That can be published in peer-reviewed journals that focus on Tier 1 capital, ROAA, ROE. Those three with Basel III as an overarching umbrella that sits upon it. And, then you could publish it, and the faculty here can read it.
Yeah, thank you so much. I'll work with you guys, because you guys have expert ideas, as I said earlier on, and then you'll be able to give me further guidance in that and support, so that we can work it and publish it together. So because I'm still new into the industry, and then there is the need for me to be held on and then to be shown the way. So I'm open up to opportunities.
Thank you. Okay, congratulations. Yes.